Hello, this is Martin from seekedge, the trading and investment channel. Today, we are starting a new series of option trading for the beginners series, and this is the first session in that. We are going to see the 4 ways to find the price range. That's the first topic that we are going to cover today. Now, why do we need to know the price range? Let's see why. The options, as we know, it allows us to take non-directional or neutral positions or trades. So the non-directional option trader, it's not necessary that he needs to have a directional bias as to where the price will move from the day of the entry till the day of the exit. It's not necessary for him to know that. So that is a way that options allows us to take non-directional neutral positions. So now the option trader need to know but the range of the price movements of the stock on the indexes. He need to know how much of the price can move up or down. He does not know where it's going to move, but he need to know a range in order to make non-directional or neutral trades in the options. So the options put or the call is bought or sold depending on the strategy that is being used. They're bought or sold at the particular strike prices, which we assume are the probable strike prices within which the market is expected to move in the time period. So the price movements range could be weekly or monthly expiry. The accuracy of the range of the price movement has major significance on the profit or the loss. So the trader may incur a loss or may need to make frequent adjustments that may cost him additional if the price range is not selected correctly. It is not just the price range. There are many other factors which we are not covering here, but essentially this is the reason why the option trader would need to know a range of movement of the price. Now how do we find this? There are different methods. We're talking about 4 methods. The first method is the volatility method. You can see the formula. If you apply this formula in the Excel, you can easily find out what could be the range. What does the formula says? You're multiplying the spot price into the VIX divided by 100, and then that you're multiplying the square root of the days to the expiry divided by 360 minus the holiday. So I'll just briefly explain. Spot is a spot price. VIX is the India VIX. India VIX value can be found from the charts. The days to expiry is how many days are left to the expiry date for which the position that you are taking. Holidays are listed. Holidays are listed in the NSE website. You can go there and see that. Days to expiry is I already explained that. So for example, if you take in 15,800 as the spot price for NIFTY, 14.1 is the volatility. If you assume that that's the current VIX, if you put the formula, the values, right? So 113 is coming because 365 minus 252 is taken as the holidays. So we get that 465 points is the price movement, approximately the price movement that could happen for this expiry if we take the position today. So Nifty can move 465 points either side from the spot for the June month expiry. So 2.33% of move can be expected from price range. So the method 2 is the average true range, right? So average true range indicator value gives the indication of what's the price movement that's expected in the select. It's an indicator that you can add to the charts. Like in the charts that you have seen, you can see that the average true range value is around 1000 for 1 month. So 1 month, roughly around 1000 points of movement is happening in the Nifty is what the true range is indicating. You can see the value for that, it may be some 500 points for the weekly, but daily how many movement is there. Accordingly, you can select the strike prices when you're selecting the option position. So that this is the method number 2. And the third method is open interest. Open interest of the options data can be plotted graphically like you see on the right hand side. So it can be selected, the options open interest data can be selected for a weekly or a monthly expiry depending on what position, which expiry the positions that we are taking. Okay. So the strike price with the highest calls, right, are seen to be the resistance price level, right, and the strike prices where the highest puts would be the support. So that way we can we can get a price range of the strikes that has to be selected. But please make a note that the options build up happens every day. So the price that you have selected, the range, while seeing the options graph that is plotted, options open interest graph that is plotted, may vary after a few days, because the price moves. So price changes happen, right? But the position has to be taken on the price levels that you see in the option, in the call and the put rate, depending on where the highest. So in this graph, you can see that 15,000 is a very high put writing, which is very strong support. Huge amount of put writing is there. So very similarly, 15,800 is the place where the maximum resistance is seen. That means the market may hover around this two range. Okay. So the other factors like depends on when you are taking the trade, how many days before the expiry you are taking the trade, right? Also because those things are only considered in the formula based VIX volatility based approach and not in this open interest only based approach or ATR only based approach. There we will have to consider the other parameters also. What is the fourth method? Fourth method is very simple. It's from the charts. If you are a technical analyst, if you know the technical chart patterns, then it is not a big task to find the support and the resistance levels, right? So support level and resistance level, so is basically what we found from the options chart also. Here also we can find the same depending on different techniques. Simple price action can help you do that. If you see that, you can see that band, what you see there is a good support area. So even if the market corrects, the market may come and settle on that price band. So that is the support level strike price. And on the top side, similarly, the resistance is there at 15,800. So that would be the two ranges that you would need. So the price action is not the only method. There are different indicator based levels can be found, like moving average, support and resistance levels can be found. The price action swing in high and low can be used. The pivot methods, various pivot methods can be used. So there are different ways that using charts and technical analysis where you can find the support and resistance, and you can take accordingly select the option strikes. These are the four methods that we can use to find the methods, use to select the strikes for the options. That's all I have. Happy learning and happy trading. Thank you.